Everyone to today's webinar. As always, we have a great one in store. Uh, Always enjoy hosting these market updates. Always a lot to talk about too. Uh, yeah, this year has been no shortage of interesting things that have been happening, and here we are, basically 1 month into Q2, and markets are actually looking pretty good. I think if you weren't paying attention necessarily to stock prices and what was happening there and just looking at headlines, you probably would think otherwise because headlines have not been good. Um, at least, in the financial media, I'll put it that way. But here we've got, I always like to just let's talk about where we've been this year, how things look. Uh, these are some major benchmarks, different asset classes. They're all stocks, and we've got these ranked on the right hand side of the graph here, from best performer for the year all the way down to worst performer for the year. So leading off, we've got emerging markets. So those are companies that are headquartered in areas that are considered not developed yet. They're emerging, not here in the U.S. So they're international companies, typically smaller in size relative to what we'll find in the U.S. markets or in the developed international markets, which are, bigger countries, more established countries. Followed by, so that emerging markets best performer this year. Next up is small cap. So those are small companies. And, small is all relative. I mean, they're still publicly traded, still very large businesses, but small relative to some of the mega cap companies that are out there. Then we've got the NASDAQ 100. So there's a lot more tech exposure in that, followed by developed international, then the S&P 500, and then bringing up the rear here is the Dow Jones. All positive for the year. Just, interesting kind of the makeup of how things have progressed. And when you look at this graph too, you'll see, all right, we're going back to the beginning of the year of 2026. Excuse me. Markets started off well, and then we had a slump in mid February. Markets kind of peaked and pulled back towards the end of March, and then once we got through that, um, had a nice rebound. Very similar to last year. 2025 had a very similar trajectory. Situations were completely different. 2025, a lot of the discussion back then was the tariffs, which are still a thing. And then this year, it's been the war and situation in Iran that was driving some of the performance on a short-term basis. Now we've got the different sectors of the market. So this is what we do: is we take the S&P 500 and we look at the major sectors, and I rank them, or at least put them in order of best performer for the year, followed by all the way down to worst performer. And the best performer this year is energy. Not necessarily surprising, again, if you're been watching a lot of what's happening here in the markets. You'll notice, and even if you're not, you go to the gas pumps, you'll notice gas is expensive, and oil is definitely gone up a lot this year, and that's all tied to the situation in Iran. And further down the list, materials, industrials, tech, real estate, and bringing up the rear, we've got financials and healthcare. And the reason I like to point this out is because this does show the power of diversification. You might work in the healthcare field, and you might know that space really well. And you might have a lot of exposure to that, maybe through your company if you have employer stock or you know, compensation, of course, if you know, how all that kind of shakes out based on your employment status and everything. But that doesn't mean the stocks are going to go up. They're going to do different things at different times. You know, energy has been it's been a great benefactor of higher oil prices, but energy has its struggles too. That sector, it does t- perform closely with oil prices. Not not on all the time where if oil's high or low. It's just when it does spike or drop significantly, energy stocks definitely react to that. And financials too, interest rates are higher, and typically that can be a good thing for financials, but financials have struggled this year too. So interesting kind of to see the makeup. One of the big beneficiaries, even with a lot of the data center and spending that these tech companies are doing, and a lot of the AI space is impacting utilities in a positive way. So moving on to interest rates. So I've got the yields for U.S. Treasuries on this graph. So, it's when you loan your money to the U.S. government, you get an interest payment, throughout the life of owning that investment or that loan, and you get your principal back at the end of the term. We've got 10-year treasuries at 4.3%, 5-year treasuries just under 4%, and 2-year treasuries just slightly lower than that. We've had periods in the past, if you've been watching these webinars for some time, where 2-year treasuries were yielding more than 10-year treasuries. That does happen from time to time. It's been probably more of a thing the last 5 years, 6 years or so. But more of a normal, what we call a normal yield curve that we've been in. But you'll also see here why I like to show this is you can see the change. Oh, my slides are moving on me. All right, you can see the change here on yields based on what's happening too in the market and the economy. So as you look here on the 10-year treasury yield, pretty stable again up until that time when the situation war in Iran, yields came down. And why is that? Well, so the interest rates on bonds, they're driven by investors' desire to own them. So you've got the Federal Reserve, they set what they call the overnight lending rate. So whenever we're talking about the Federal Reserve and them deciding what interest rates are, that's just kind of what they say. Hey, if member banks are going to borrow money from us, this is what we're going to charge. That's not necessarily what US Treasuries are. They don't impact that directly. There's an indirect relationship because everything kind of keys off that, but it's not like when they decide to keep rates the same or raise rates that government bonds just instantly change based on that. Government bonds are more of a supply demand issue. But again, I mean, there's a very high correlation to all of those interest rates, but supply and demand really drives these. So when people are fearful and they're selling stocks, it's common for then money to flow into bonds or into treasuries. And so when money flows into treasuries, interest rates come down because there's now more demand, more people wanting to own them, and yields come down to reflect that. And then on the flip side, when people say, hey, I don't want to own these treasuries anymore, I want to sell them and maybe buy stocks. Well, then when they're selling those bonds and there's more sellers than buyers, then yields go up. And that's what we're seeing then from March 2nd all the way through the end of the month. And then we've been fairly stable since then. So just a little background on interest rates and how all those how they fluctuate based on what's going on in the market and the economy. Now this is going back a year, and what I've got is different baskets of government bonds. So the red line, the red, you can see it's very, very straight. And that's represented by this ETF called SHV, and it's very short-term treasuries. Very, very similar to like money market. So these treasuries, they mature in less than a year. And so they don't fluctuate very much. And then the longer term you go out on the yield curve. So when you go and invest money in 20-year treasuries, well, you don't get your money back if you go buy a 20-year treasury. You don't get it back for 20 years. So they're more sensitive to changes in interest rates while you hold them. Now, you'll still get the interest rate. Like if you went out and bought it, you'll get the interest rate that they guaranteed you, and you'll get your principal back at the end of the term, assuming the government doesn't default, which it's never done that, and no expectations for them to do that. But in between, from the purchase to the day it matures, you do have the ability to sell it in the open market, and that's going to be impacted by the price that you're going to get is going to be impacted by what current interest rates are. So then when you see these fluctuations, what you're seeing is the market saying, hey, if you want to sell it, here back in end of May 2025, you're going to get a lower price than if you sold it. You waited until end of October 2025, you're going to get a higher price because interest rates have changed over that period. So that's what that reflects. And so the longer the maturity, the longer the term of the bond or the treasury, the more impact these fluctuations are going to have. You can kind of see how bonds are performing. So that previous graph, these are yields. That's the interest rate. This is now the performance kind of tied in with the interest rates too. So, it's been interesting year over especially on like the stock side of things, but in bonds as well. And let's talk about kind of how what's driving that. Well, a lot of that is what's going on in the economy. And I always like to talk about these key leading indicators. I believe these are very important components to the economy that will help drive or determine the direction of stock prices over the next 12 months. So we've got the employment markets. Excuse me here. And employment is very important to the US economy. And the reason is because we are a consumption-based economy. It's services primarily, not manufacturing. Yes, there's components of each, but manufacturing, well, yeah, there's a lot of talk about manufacturing and reshoring, and that's happening, and that's great. But our manufacturing percentage of GDP and jobs, I mean, it's 10%, and it's been on a downtrend for 100 years. And yeah, sure, it might be coming up a few percentage points, but it's not going to just all of a sudden flip to where it's now 90% of the economy. That's just not going to happen. The service industry is very large, and I think it's just going to continue to be that way. But overall, though, it's because we're a consumption-based economy, people, they need to have jobs to spend money, because when they spend money, that turns into revenue for publicly traded stocks and even private companies. And then that revenue flows through the balance sheet and the all the financial statements and turns into earnings, and stock prices are a function of earnings. So if there's less jobs or if people are losing their jobs, well, they have there's now less money being spent in the economy, which then now reduces earnings. So that's why jobs is so important to the future of stock prices in the US. So here you can see here, this is going back 10 years, jobs market. Then we had the recession, COVID recession here in 2020, and that's whenever you see these gray bars on these Federal Reserve graphs, those represent recessions. And then we had the job market rebound post COVID, and then we've been on a slow, yeah, still increase, but slow increase over the last several quarters, but it is still positive. Almost 160 million people employed here in the US. Job openings too, again, another good indicator, because this is companies and businesses saying we are looking to hire, and we're still right at the peak of what it was pre-COVID, even though it's come down from the post-COVID highs. There's still job openings here in the US, and it's definitely been more stable here. Yeah, it has its little peaks and troughs, but uh, more on a sideways motion the last couple of years. Yeah, companies are still looking to hire, and that's again a positive sign. This is now an unemployment metric. So this is continued claims for unemployment. And the reason this is important too is because when I talk about jobs, I showed the total employees here in the US. Well, how do we determine, okay, is that number going to change significantly in the future? Are we going to see a bunch of layoffs or not? Well, that comes out once a month. The government publishes the jobs data beginning of every month. Throughout the month, though, we get updates on unemployment. And so that gives us some insight into, okay, well, if people are laid off, well, typically the first thing they're going to do is file for unemployment if they don't already have another job lined up. And that is being tracked, that the government tracks unemployment claims. And we can see, okay, pre-COVID, fairly steady. COVID hit, huge spike. I mean, this was like insane. If you look at this on a very long-term graph, it's just never been that high before. Came all the way back down, and then we've been very steady over the last several years, and it continues to be steady. So again, there aren't signs of weakness in the jobs market. Been very steady. Retail sales, again, this is another metric on, okay, are people spending money? Yes, retail sales continue to increase. Housing, this is permits for new homes. And yeah, we had nice steady rise kind of post 2008, 2009, the global financial crisis. COVID there in the middle, and then continued increase kind of post COVID. And then as interest rates have come up, that has slowed, but we're seeing some steadiness here, and actually a slight increase on new housing developments. I think that's a good sign. Business spending, so I mentioned we're a consumption-based economy. So GDP, that's the value of all the goods and services produced here in the US on an annual basis. And 70% of that is driven by consumers, consumption. And then 20% is driven by businesses, what they spend money on, inventory and things like that. So it is a big piece. And businesses are continuing to spend, which is also a sign to say they're feeling good about the outlook to continue to spend. You can see some sideways motion here last few years, and then now pretty significant increase over the last 12 months on business spending. And then the last graph I have here is on the yield curve. Yeah, I talked about interest rates early on. And what this looks at is the 3-month treasury relative to the 10-year treasury. So what we've got is this black line. If you see this in the graph, this black line. Anytime the blue line is above the black line, that means the 10-year. So when you loan your money to the government for 10 years, you're going to get a higher interest rate than if you were to loan your money to the government for 3 months, which intuitively makes sense because you're tying your money up for longer. You expect to receive a higher rate of interest. I mean, think of it like if you were to go to the bank and look at CD rates, you would expect a 10-year CD to pay you more interest because you're tying your money up for longer than if you were to buy a 3-month CD. The direction of that blue line then it changes based on, okay, is the 3-month increasing relative to the 10-year? And when the interest rates for 3 months gets closer and closer to the 10-year, the blue line is going to start coming down. And then if the 3-month rate is higher than the 10-year rate, then the blue line is below the black line. And we call that an inverted yield curve. And that doesn't happen that often. And the reason I'm pointing this out is because historically, an inverted yield curve has preceded recessions. And why are recessions such a key thing that I talk about a lot? Well, we see significant market events, typically downturns or corrections, pullbacks, whatever terms we want to call them. But when markets go down and go down significantly, it's typically around a recession. And depending on the severity of the recession, stocks can go down for a long period of time and stay down for a period of time. Now, over when we take a step back and we kind of zoom out a little bit, I mean, they go up long term. It's just we have these pockets of volatility. And when investors and people are making decisions, I think a lot of them they're fearful of the next recession. I mean, again, it's like what all the headlines are focused on. It's just everything's negative because everyone wants to predict the next recession. I mean, there's more people that have predicted, it's actually kind of a funny joke, I think, in our industry where they say, so and so's predicted 15 of the last 3 recessions, meaning they're constantly saying the sky is falling. You'll see that all over the media all the time. There's always people out there. They're always telling you because they want to sound like they've got the inside scoop. They're smarter than everyone else. No one else knows. They're not paying attention to the right stuff. Everyone's just being happy, whatever. And they want to say we're smart and prudent and things are crazy and we're whatever. They're wrong. Most people are wrong. The market goes up most of the time. And it's because, well, we've got a system here that businesses figure out how to make profits. They don't just shut their doors because the rules change. I've never seen a business just say, you know what, we don't like what's going on in the political environment, so we're just closing up shop, calling it quits. It doesn't happen. Businesses figure it out. whatever the rules are, whatever they change. Yeah, sometimes the changes are they're going to impact earnings, and it's going to take a little bit to figure that out. But they figure it out. That's what happens. But back to the discussion here on recessions. When we see these inverted yield curves, what you'll notice is they happen prior to the gray bars, which is the recession that I've been talking about. Here's 90s, that wasn't necessarily a very deep recession. Then we had 2000. Again, really not a very deep recession. That was just more stock market reacted more to valuation issues, and that was primarily in the tech stocks because there were pockets of the market that performed well during that. Not just everything just didn't go down in early 2000s. I think this is what a lot of people remember is 2008, 2009, the great financial crisis, as it's called. That was a deep recession, and it did impact pretty much every aspect of the market. Market peaked in October of '07, stopped going down, finally hit a bottom March of '09, and then it took a couple years to get back to even. We had inverted yield curve pre-COVID, and then we've been inverted for some time now, and now it's uninverted or back to a normal yield curve where we sit today. And the reason I'm pointing this out is because there's been a lot of discussion about this inverted yield curve, uh, especially 2020 and what was happening here, kind of post-COVID. It's a very good indicator, but at the same time, there's limitations. Not every indicator is perfect, and there's been a lot of Federal Reserve intervention in the bond market, especially the Treasury market, with their quantitative easing, quantitative tightening, and so that's caused this inversion, I believe, more so than just the economy. So in these previous ones, this is more of the economy creating this and the Fed reacting to it. And why does this kind of precede a recession? Well, when short-term rates are higher than long-term rates, that's considered a tightening of capital. So that makes access to capital more difficult and more expensive, which then slows things down, slows growth down, and historically, again, like what we're seeing is that eventually can lead to a recession. I wouldn't say this one pre-COVID, the inverted yield curve didn't predict COVID. That was more of a government situation here. And then kind of post, this was quantitative easing, quantitative tightening. I mean, all that going on, that was actually part of post 2008, 2009, but it was still in effect pre and post COVID. So why we didn't see a recession necessarily right after this. Let's touch on earnings here. Earnings are extremely important, as I mentioned earlier. Stock prices are a function of earnings. Yeah, I mean, we can see prices go up or down on a daily basis, and it's not because earnings necessarily changed or the expectations changed that instant, but maybe that's there's different viewpoints, and that's what's great about the market is people get to decide what they think, and they get to buy or sell anytime the market's open, here in the Midwest between 8:30 and 3, and make a decision. And if there's more sellers than buyers, then prices generally go down and vice versa. So it's ultimately this is what people are making those decisions on. If there's headlines out there, they might, well, that's bad for earnings, that's good for earnings. Again, it's really all kind of comes back to earnings. What I've got here is the earnings estimates for the S&P 500. So the S&P 500 is it's a broad-based benchmark. 500 largest companies in, headquartered here in the United States. And it's weighted by the size of the company, meaning that the bigger the company is, the larger weight it has in the S&P 500. So there are now companies that are valued at trillions of dollars from these big tech companies. And they're large components of the S&P 500. So they're going to have a more of an influence on the change within the S&P 500 than a company that maybe is only worth 25 billion, which is, again, it's a large in the grand, relative to a lot of things, but relative to a $1 trillion company, not very big. So that's how the S&P 500 is weighted. And then what happens next is then they slice up all okay, well, if this company is 10% of the S&P 500, well, then we're going to take 10% of their earnings and we're going to add them all up and we're going to get an estimate for the S&P 500 as a whole. That's what these analysts do. And then they come out and they come up with quarterly projections. So now what I've got here, quarterly projections going back to Q3 2024, all the way projected out to Q2 2027. And these forward projections are very important because the market's looking at those and it's applying a multiple. And I'll show you what those multiples here are on the next screen. The dark line, those are earnings that have come in and they're actual. They're not estimates anymore. Those are finished, completed, Q1 2025's over with. Yeah, and even though we're done with Q1 2026, there's earnings that are still coming out that are being announced, so it's not completely finished yet, really, until we get more through Q2. But you can see what the estimates are. 2024, about $243 a share was the actual. 2025, 271. And then the estimate for fiscal year 2026, 325, and then 376 for 2027. So again, why is this important? Well, the market, analysts, they say, okay, well, if the expectation is for the S&P 500 by the end of 2026 is to have $325 a share, $326 a share of earnings. Well, if we apply a multiple to that, then we get a value for the S&P 500. So a target. And as we move through the year, investors and analysts, they're always forward looking. So it's not about current earnings necessarily as much about future earnings. We're forecasting, but we're also, it's like, well, yeah, today prices are today, but at the same time, it's a reflection of what everyone expects to happen in the future too. I mean, the past is behind us, so there's, that's over with. It's all about what's projected going forwards. Like, for example, if all of a sudden there was a big, if Congress passed a bill that said businesses don't ever have to pay any taxes again, and that was announced today, well, then forward earnings estimates would go way up because they'd say, okay, let's take out all the tax expense out of earnings. Because that's all it, but it's all in the future, even though that got announced today, it's all in the future. Because we're in Q2, what I did is I took each quarterly estimate from Q2 2026 through the end of Q1 2027, so that we've got 4 quarters. If we project that out by the end of, so 12 months in the future, earnings estimates, $343 a share. And when I put this together on the use the closing price on February 28th or closing value of the S&P and said, okay, well, if the multiple, if people are willing to spend or to pay 18 times $343, what would the projected value of the S&P 500 be? Well, it'd be 6,174. That'd be about 1,000 points less than where we are, or at least where we were on the 28th. What about 20 times earnings? 6,800. What about 22 times 100? 22, 7,500. And 24. And the reason I'm using these is because this is the range we've been in for quite some time. Now, you can look back and look at earnings and multiples over, going back many decades. Lot of studies on because everyone, what's the right multiple? There is no right multiple. There's no consensus that's like, well, if the everyone agrees it's 20, so we're all just going to key off 20. No, for some people, it's like, I'm willing to pay up because I think the outlook is great. And I think people are not even projecting as earnings will be better than what the analysts are projecting. And others might say, I don't want to pay that much. That multiple is too high. When you look back historically, I mean, multiples have been lower. And so there's been a lot of discussion last 10, 15, 20 years even about multiples are high, multiples are high. And when you pay, higher multiples, future returns are lower. Well, they haven't been. And I think a couple of reasons for that is because, well, information now is a lot more accessible. You go back 50 years when multiples were lower is because information wasn't easy to access. So people weren't necessarily willing to pay as much back then. It was a different environment. Every day we're getting updates on our cell phones, nonstop alerts. Again, it's like instantaneous information. And I think because of that, multiples are higher, and I think they're going to stay higher. But when we look at this range, that gives us a projected target for the S&P 500. So, and I'm using it as a proxy for the market over the next 12 months from negative 13.5 to plus 15. 12 months in the future. Now, if multiples come down to 18, well, what would cause that? Well, here's what would cause that. That would be weakness in the economy, cracks in the jobs market, earnings expectations now start to decrease because of that. And that would bring multiples down, which would bring the price down. Interest rates are also kind of a component of multiples too, because if interest rates are high enough to where investors really were weighing the options, like if you could go buy a CD or park it in, put money in money market and earn 10%, you may say, well, I'd like to do that versus owning stocks. And so that has an influence on multiples too. So that's why we talk about interest rates a lot too. And two, it's going to change the outlook and projections and everything else for the bond market. Now here I've got interest rate expectations. So this is investors, they're going out, people, they can purchase what are called interest rate futures. So what people think interest rates will be in the future. So the market is pricing in that interest rates will basically be the same by the end of 2026. So that is like base case. Now this can change, in a heartbeat based on data and what the Fed says and everything else. the expectation are that interest rates are going to stay the same. In 2022, this was the surprise. At the beginning of 2022, the outlook for interest rates was a very minimal, small increase by the end of the year. Instead, interest rates went up 4 or 5%. They went up a lot in 2022. So at the beginning of the year, market was expecting one thing, and then throughout the year, it wasn't what the market expected, and that's why the market dropped a lot in 2022. Again, we're at all-time highs today. So I mean, we talk about these market drops, but it's like we can live through those. They're just not fun to go through when they happen. Okay, let's talk about moving forward. I showed this chart, stock market since the beginning of the year, and it's very similar to last year, but it's been difficult, and it has tested everyone's patience. The lot of questions, again, I thank everyone for submitting their questions, and we got a lot of questions about the war in Iran and the impact that it's going to have. And whenever I talk to people about this, I talk about earnings a lot, and I talk about the jobs market. And while yes, I mean the war in Iran, it's gonna have its impact on the market in certain areas. For example, energy. Yeah, oil. Oil is fluctuating based on what's going on in Iran, and that's impacting the energy sector. But what we have to then kind of ask ourselves, like, how's that going to impact the jobs market long term here in the United States? And what impact on earnings is that going to have? Now, I'm not saying it's not going to have any, just that's the question we have to think it through. Is that going to have a significant impact on it? And I'll talk through that as we go through the remainder of the presentation. This is GDP, as I've mentioned, it's the value of all the goods and services that are produced here in the United States. Our most recent number is for the end of Q4 2025, and there's two components on here. So we've got gross domestic product, so that's just the number 5.3%. But what's commonly quoted whenever you hear this, if you happen to be paying attention to the financial news when they're discussing the GDP release, which typically comes out quarterly, they're quoting a lower number, and they're quoting what's called real gross domestic product. And what real means is it's net of inflation. So they strip inflation out of it. And the reason they do that is because inflation will have an impact, and we want to make a comparison to historical periods. It's much cleaner without inflation factored in. But the headline number, the top number, the blue line, that is the number. I mean, that is the percentage increase. Inflation has been higher than where it has been historically, because you kind of look back this last 10 years, there's not as much of a gap between the red and blue line when inflation's low. And then again, as we see inflation increase, there's a big gap there. While yes, growth has slowed, it's still positive, but we have a huge economy here. It's not going to grow at double digits or beyond that. We're too big to continue to grow at that pace. Earnings have been great. AI, there's a ton of spending that's continuing to happen on that, and I think that's just going to be a very long-term driver to things. And then, yeah, Fed policy too is going to be important. Inflation has to cooperate. The Fed, I don't. We'll see kind of how they're very data dependent, and I don't think they're going to make any significant changes to interest rates when inflation's where it's at. I mean, we're close to 3% or so on an annualized basis on the headline inflation numbers. And they'd much rather have it closer to 2. So while, yeah, it's not out of control by any means, it's just higher than where they want it. And I think they're going to continue to keep rates where they're at. They met yesterday and they maintained interest rates, which wasn't a surprise, but just kind of where their heads at currently. Jobs market. So if we were to see signs of weakness in the economy, no matter the cost, it does, whether it's the war in Iran, and how could that cause weakness in the US economy? Well, here's where the impact would show up. Higher oil prices, one, that that just means consumers have less money to spend on other things. If they're spending more money at the pump, then because they have a finite budget. Yes, I mean it does. People generally get raises and cost of living increases and things like that. But when it just changes quickly, like it did this year, there's not time for that to work its way out. So higher oil prices that are high for a long time. I mean, people can absorb it on a short-term basis, long-term basis, that's a little bit more difficult. And two, so that then less revenue that goes to other things, which potentially reduces earnings on the market. And then depending on the company and the industry and what they're in, okay, is there higher input costs now for the products that they're making or the services that they're providing, which then either eats margin because they don't want to raise prices or have to raise their price. And if companies are receiving less revenue, less margin, they could start to think about laying people off to start to, hey, we might see some weakness because of this. And now we want to be ahead of it. We're going to start to reduce our workforce. And we start to see layoffs. And if we were to see layoffs, we'll see them in this initial claims. This is the 4-week moving average of initial claims when people first sign up for unemployment. And again, this comes out every single week. No signs of any, and we can't take any small, we need to see a bigger trend change here, but no signs of it currently. We keep a close eye on this. And again, this comes out every week. Here's the inflation numbers. Gives us some insight into interest rates. As much as the Fed would like this to be lower, it's been difficult. And this is where the oil, is that going to mean this number's going to stay higher for longer, which then doesn't necessarily give the Fed a lot of room to potentially reduce rates. Interest rates here again, expectations are for them to stay the same. So there isn't necessarily the markets like if they don't go down, that's a bad thing. This is where it's priced in to stay the same. Now, if they go up, that doesn't necessarily moving up a quarter isn't the end of the world, but a significant change, essentially a significant increase in interest rates it would be a surprise for the market for sure. I don't think we're going to see that, but We keep our eye on it. And money's been moving around too, which is good. We call it rotation. There's periods where different industries do different things at different times. Some of these industries are more cyclical, meaning the economy's in a growth phase, they're doing great. If the economy's in a peaking phase and potentially rolling over, they're going to struggle. Then you have others that are industries that are more defensive in the sense they're they sell products or or services that people buy no matter what, like healthcare. Healthcare is considered a defensive industry because people spend money on healthcare essentially no matter what's happening. Consumer staples, that's a defensive sector. So that's the goods and services you buy, a lot of like at the grocery store. People are still shopping at the grocery store. Now they may change where they shop, but they're still buying food, they're still buying toiletries, they're still buying those things, and that's what consumer staples are. Consumer discretionary, yeah, those are things that discretionary expenses, travel related things, vacation related things. If money's tight or if you're potentially lost your job, you may not spend your money on that. This is similar graph to what I had earlier, except I added here's the performance over the last month. So year to date, energy's up a lot, but over the last month, it's come down some. Same with technology. I mean, it was really struggling there for a while. It's picked up here in the last 30 days. Same with consumer discretionary. You know, interesting to see how these rotate. Here I've got the two measures for oil. One is Brent, and the other is West Texas Intermediate, WTI. And Brent is more of the proxy for international oil prices. Those are, typically it's at ports that are easy to ship across the world. WTI produced here in the US, not as easy to ship across the world because of where it's located. So they tend to follow each other closely, but they do slightly different things at different times. But yes, as I was mentioning, if oil stays high for long, and it definitely if it's spiking higher, a stable, even if it's high but it's stable, companies have time to start figuring out, consumers have time to start figuring out. Plus, over time, if it's not changing, it gets built into the budgets. Short term, it's going to have an impact, but long term, it's going to have less of an impact. But if it does stay high, I mean, over the next couple quarters, that'll be an issue. Now, we do have the midterm elections coming up, so I think there's going to be a lot of talk about this because I think both of the political parties are going to be focused on it and doing what they can or saying what they need to say. I mean, sometimes things don't necessarily have to change. It's more about what the wording, the verbiage, whatever, that can make an impact more than anything. Yeah, companies are doing great. Profit margins are performing really well. Companies are earnings are great and their margins are really good. I mean, again, inflation, oil, government policy, that's always a risk, but the outlook is very positive. Earnings again are really looking good. Estimates are good, margins are healthy, businesses aren't laying people off, so consumers are in a good spot. But I believe that supports our outlook. On the higher side, when I showed that projection, 18 to 24x on the earnings, I think we over the next 12 months, closer to the higher side. Yeah, forward earnings. I mean, again, this is forward earning expectations. So this one on the left here, you can see my mouse. That's what this black line is. It's just going back and always plotting what forward expectations were at that time. And look at these earnings expectations. I mean, they just continue, and it's because it's expectations in the future will be driven by what actually happened. So it's not like, well, actual is significantly lower. No, it's yes, they may, be off in the sense of what the expectations are today and what actual is, but as actual comes in, forward adjusts. I mean, look, there's been go back. I mean, this is not that long ago. 3 years ago, 2023, $225 a share. Look at where we're at today. I mean, it's almost up 50% in earnings over that period. And then same here's margins. Margins phenomenal. And I got some questions on market. Market's at a high. A lot of concern about Iran and oil and political environment. And I think it's important to kind of think about new highs, and because again, we have a lot of data. We can look back at history, and this is a great graph, a great chart. So what we've got here is if you were to invest in the market, in the blue, if you invest, and this is going back to 1950, if you invested at all-time highs, so market hit a peak and you looked forward 12 months, every time it hit an all-time high, what was your return versus just any point if you invested and then looked forward 1 year? It's nearly identical. 3 year, you actually got a better return by investing at all-time highs versus just picking random, or just using any date, and similar to the 5-year return. If you just looked at all other days, because all-time highs actually tend to lead to more all-time highs. It's a factor. When we kind of look at all these different things, there's a lot of studies on what drives markets. Earnings, of course, as I mentioned, being a key component. And there's other factors like momentum is one of them. Things that are increasing in value tend to get people's attention. And a lot of times it's because, well, earnings are going up, so they're now increasing in value. Outlook is increasing, and that can attract more money, which then continues to increase it in value. So that's a momentum factor. Very strong factor. Well, we're at the top of the hour here. I appreciate everyone for tuning in to today's webinar. Appreciate all your questions. Tried our best to address all of them. If not, we'll reach out to you and get those answered for you. And to check out our podcast, Keen on Retirement. You can find that on our website, keenwealthadvisors.com, under the Retirement Resources tab. We will do our best to answer additional questions that we receive throughout today's webinar on a future podcast episode. And lastly, if you'd like a copy of Mr. Keen's best-selling book, Keen on Retirement Engineering, the Second Half of Your Life, please send me an email, send anyone an email, reply to any emails that you receive from us and request a copy of it, and we will send that out at our expense. Happy to do that for you. Again, thank you all for joining. You'll see the replays. We're going to send out links to the replays. We'll have it posted on our YouTube channel, youtube.com/Keen Wealth Advisors. All right. Have a great rest of your day.